What if we told you that you can profit from inflation? And currently, the country's economy is going through inflation. So, if you want to know how to profit from inflation, get on board with us and watch this video to the end. Hey guys, welcome back to another fascinating episode of Passive Income Ideas. Today we will talk about 7 astonishing ways to profit from inflation. Before we move forward, don't forget to give us a thumbs up. Also, make sure to subscribe to our channel and turn on the post notification to not miss out on future updates. So, let us dive in, shall we? As the financial system rebounded after the Great Recession, inflation remained low. Inflation has never risen beyond 2% for numerous years. Inflation has made a comeback in recent months. Although President Biden has described the current situation as transitory, many people believe that inflation is here to stay. So, firstly, we need to understand inflation. What is inflation? Inflation is defined as an increase in prices in an economy over a given time period. The Federal Reserve usually strives for a low and stable inflation rate of around 2%, which signifies a developing economy. However, economic shocks can drive inflation to reach double digits. Throughout history, inflation has varied. Prices rose 10% to 15% in certain years during the 70s and 80s. Inflation has slowed since then. Inflation rates range from 2% and 5% in the 2000s, whereas they stabilized between 0% and 2% in the 20-teens. In other words, relative to previous periods in history, prices have remained fairly constant in recent years. So, now let us look at the astonishing ways we can profit from inflation. Due to inflation, today's dollar will not buy the same value of goods as it did 10 years ago. Number 1. Real estate. Real estate is a popular investment because when inflation rises, it becomes a more valuable and popular store of value while also increasing rental revenue. Real estate can be purchased directly or through the purchase of shares in a real estate investment trust, REIT, or specialized fund. During periods of inflation, single-family houses funded with low interest, fixed-rate mortgages do well. As inflation rises, the worth of your home is likely to rise, while the monthly service cost of your mortgage stays the same. This is at the heart of accumulating home equity, which may significantly boost your net worth. You may protect yourself from increasing rents by acquiring real estate. Like any other consumable commodity, rents tend to grow when inflation rises. Mortgages have a benefit over rental agreements when inflation is high, despite the fact that they are less flexible. During a period of sustained inflation in the 1970s, real estate performed extremely well. However, as shown in 2007 to 2008, real estate is sensitive to rising interest rates in financial crisis. And rising interest rates is the traditional monetary policy response to rising inflation. Real estate investing, like any other investment, has advantages and disadvantages. To begin with, the transaction expenses of acquiring real estate are significantly greater as compared to purchasing shares of a stock. Second, real estate investments are liquid, which means they can't be sold quickly and readily without losing significant money. You have to pay for management and maintenance if you buy a house, which can rapidly mount up. Finally, real estate investing entails assuming a significant amount of financial and legal risk. Number 2. Commodities. When inflation rises, investors frequently seek tangible things that will appreciate in value. Gold, and to a lesser extent other precious metals, have been the premier shelter for millennia, prompting prices to climb when inflation rises. Gold can be acquired directly from a bullion or gold dealer or indirectly through purchasing a gold mutual fund or exchange-traded fund, ETF. A commodity can also be purchased directly or indirectly through an ETF or specialist mutual fund. Raw minerals and agricultural goods such as oil, copper, cotton, soybeans, and orange juice are examples of commodities. In inflationary conditions, commodity prices tend to grow in tandem with the pricing of finished goods derived from those commodities. Higher crude prices, for example, raise the cost of fuel and transportation. Sophisticated investors can trade commodity futures or producer stocks. Exchange-traded funds that invest in commodity futures, on the other hand, will underperform a rise in commodity prices since their future contracts must be rolled when they expire. Simply put, when demand rises in the economy, prices rise, and the cost of production to supply, demand often climbs in lockstep. During times of uncertainty, commodities are commonly seen as safe haven investments. Commodities are uncorrelated to typical asset classes such as equities and bonds and move in opposite directions. Before investing in commodities, investors should be aware that they are extremely volatile, and commodity trading should be approached with prudence. Because commodities are based on demand and supply, even a little shift in supply due to geopolitical tensions or wars can have a negative impact on commodity prices. Number 3. Bonds. Tips. Treasury inflation-protected securities are marketable U.S. Treasury securities designed to offset the erosion of buying power. TIPS offer periodic inflation adjustments, which are not available with traditional fixed-rate bonds. TIPS should be considered as a part of a lower-risk portfolio component for investors seeking capital preservation and buying power stability. TIPS holders may be certain that their principal will be returned since TIPS are guaranteed by the U.S. government's full faith and credit. Bond investing may appear paradoxical, given that inflation often harms fixed-rate debt. On the other hand, inflation-indexed bonds have a variable interest rate connected to the rate of inflation. Treasury inflation-protected securities, TIPS, which are tied to the Consumer Price Index, is a popular alternative in the United States. The value of a TIP investment grows in tandem with the CPI. Not only does the base value increase, but because the interest paid is calculated on the base value, the number of interest payments also increase. Foreign types of inflation-indexed bonds, such as those issued by other governments, are also available. Inflation-indexed bonds can be purchased in a variety of ways. TIPS can be purchased directly from the United States Treasury or through a brokerage account. Some mutual funds and exchange-traded funds also hold them. Consider trash bonds for a more daring strategy. When inflation rises, high-yield debt, as it is formally termed, tends to appreciate in value as investors seek out the greater returns given by this riskier-than-average fixed-income instrument. Even while TIPS may appear to be an appealing investment, there are a few concerns that investors should be aware of. The principal amount may decrease if there is a deflation or the Consumer Price Index, CPI, fails. If the bond's face value increases, you have to pay more tax. And this could nullify any benefit you may receive from investing in TIPS. Finally, TIPS are susceptible to changes in current interest rates, so selling your investment before maturity may result in a loss. Number 4. I-bonds. Savings bonds in the U.S. become attractive investments during inflationary periods. I-bonds guarantee to keep up with inflation despite the fact that you may only buy $10,000 per year, and they're classified as non-marketable assets. They, like TIPS, provide a particularly assured return of capital. Investing in I-bonds will not yield high profits. Still, it will protect purchasing power for a portion of your portfolio. Given that many assets, such as cash and long-term bonds, are expected to lose real value during inflationary periods, it is sensible to consider alternatives to equities that can stay up. Number 5. Stocks. Stocks have a good chance of keeping up with inflation, but not all shares are made equal when it comes to doing so. Inflationary periods, for example, tend to batter high dividend-paying equities like fixed-rate bonds. Investors should look for firms in the consumer staples category that can pass on higher input prices to customers. According to some data, value equities outperform growth companies during inflationary periods. Compared to their present share price, companies with good earnings are considered value stocks. They're also recognized for having strong cash flows, which investors price when stock prices increase. Number 6. Loan/debt obligations. Leveraged loans can also act as inflation hedges. They are a floating rate product, which means that banks and other lenders can boost the interest rate paid to keep up with inflation. Mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, respectively, are structured pools of mortgages and consumer loans. Investors do not own the debts directly, but rather invest in securities with loans as the underlying assets. MBSs, CDOs, and leveraged loans are complex, dangerous, depending on their rating, securities that frequently require substantial minimum investments. Buying a mutual fund or ETF specializing in these income-generating products is viable for most individual investors. Loans, like any other investment, loans require a trade-off between rewards and dangers. Credit default, liquidity, and fewer safeguards are some of the dangers of investing in funds that invest in leveraged loans. Leveraged loan borrowers may be forced to close their businesses or become unable to pay their debts. Leveraged loans may be more difficult to buy or sell than publicly listed assets. Finally, compared to typical loans, leveraged loans have fewer limitations in place to safeguard the lender. If the borrower is unable to repay the loan, this might expose the fund to further losses. Number 7. The S&P 500. Long-term, stocks have the biggest upside potential. In general, enterprises requiring minimal capital benefit from inflation, whereas businesses engaged in natural resources are inflation losers. The S&P 500 currently features a significant concentration of technology companies and communication services. They own a 35% stake in the index. Technology and communication services are both low-capital industries, so they should benefit from inflation. Investing in the S&P 500 index, like any other investment, has its drawbacks. The key disadvantage is that because the index assigns bigger weights to firms with higher market capitalization, stock prices for the largest companies have a considerably greater impact on the index than stock prices for companies with lower market capitalization. Furthermore, the S&P 500 index does not include any small-cap businesses, which have traditionally delivered better returns. Consider inflation to be an opportunity. Consider inflation as an opportunity to reassess your whole portfolio, as it occurs with or without our consent. Maintaining a properly diversified and fully invested portfolio is one of the greatest methods to resist inflation. Long-term, money invested in equities tend to beat inflation. In contrast, real estate, commodities, tips, and I-bonds can only provide more diversification. If interest rates begin to climb, cash on the sidelines will lose value, while long-term bonds will be impacted. In general, inflationary periods provide a chance to review your financial condition and make adjustments in preparation for the future. Now let us briefly look at the pros and cons of investing for inflation. Advantages and disadvantages of investing for inflation. Every sort of investment hedging has advantages and disadvantages, just as every type of investment does. The numerous assets discussed previously also have good and negative aspects. Investing amid inflation has the major benefit of preserving the value of your assets. The second reason is that you want your savings to continue to increase. It can also lead to diversification, which is also a good idea. Spreading risk across many assets is a tried and true strategy of portfolio design that can be applied to both inflation fighting and asset growth strategies. Advantages. Investing for inflation preserves your portfolio's worth. It diversifies your holdings. It maintains your income's buying power. Low and stable inflation can be an indicator of a growing economy. It benefits holders of fixed-rate debt, such as mortgages. It encourages consumption today rather than later. Disadvantages. The main disadvantage of investing for inflation is increased exposure to risk. It also diverts you from your long-term goals. Another disadvantage is an overweight portfolio in some classes. Inflation reduces purchasing power since each dollar buys fewer goods. Higher prices throughout the economy hurt retail consumers. It harms retirees living on fixed incomes. It prompts action by the Federal Reserve. On the other hand, the inflation tail should never wag the investing dog. Don't stray from your investing plans to find targets or timelines if you have them. If your portfolio demands large capital appreciation, don't put too much emphasis on tips. Also, if you need money for retirement, don't buy long-term growth stocks. Inflation fixation should never push you outside of your risk tolerance comfort zone. There can be no assurances. Traditional inflation hedges don't always work, and unusual economic situations can often favor unexpected assets while leaving what appears to be obvious winners in the dust. Up until now, we've talked about how to profit from inflation and its pros and cons. Now the next question is, why consider inflation? Why take inflation into consideration? Inflation has a lot of unsettling impacts, but the most obvious is that it will gradually destroy your purchasing power. As inflation sets in, a dollar will purchase fewer goods and services than it did previously. Because interest rates have been unusually low over the last decade, long-term investors and retirees alike have become increasingly complacent about the possibility of inflation. In the future, inflation must be recognized as a significant danger to a pleasant retirement if it is not properly accounted for. Inflation adds to the economy's instability. Inflationary pressure enticed the Federal Reserve Board, which is anticipated to respond by raising interest rates. In the short term, the Fed's actions may increase stock market volatility, and higher rates may lead bond funds to lose value. At the very least, The prospect of inflation and increase in uncertainty is an additional incentive to review your investment strategy to ensure that your assets are adequately diversified. A well-diversified portfolio that isn't overly reliant on any one asset class is a smart first step towards inflation protection. Now that has been all for today. Have you all invested in at least one of these? With the current inflation in the country, what are your plans ahead? Do tell us your views, plans, and opinions in the comments down below. Did you find the video informative? What would you like us to talk about in the next episode? So before we say goodbye, make sure to smash that thumbs up button. Also subscribe to our channel and make sure to turn on the post notification to never miss out on future updates. Have a good day. Until the next video, goodbye.